been challenging in every aspect, and supply chains has been stressed both on the financing side as much as the logistics and every component to it. Uh, we've seen incredible amounts of interest for companies to readapt and adjust their supply chains. Some had to do, obviously, with COVID and operations being disrupted in ports everywhere in the world. Other disruptions have been the fact that some of the traditional financiers, primarily banks from Europe, due to capital restrictions and Basel III and IV, they had to rethink their participation in the market. This opened the door to alternative investment firms like ourselves to fill that gap.
I think it's a really challenging in a way to think whether we're really out of a COVID-19 crisis, or we are out of it. My personal view is that it's not over yet. At least if we look at the actual latest figures we have available for the steel market in Europe, which are, as I will show later in my presentation, are up to Q3 2020. We are not yet out of a crisis. Bearing in mind that the European steel market was already in a downturn and was already in rather weak conditions before the outbreak of a pandemic. So the downturn in steel market conditions started already in, I would say, in the second half of 2018 and first half of 2019. And then it continued, and obviously was much worsened by the impact of a pandemic, which caused major disruptions in supply chain and plummeting steel demand and so on, and what we've seen recently.
Well, the prices today, both on my raw material as well as on my finished goods side, is much higher than the highest price that I've seen during the pre-pandemic times. And multiple things go into it. One is just a herd mentality of the buyers who wanting more and more when the prices go up, when they see a small recovery, because the expectation was during the pandemic, right in the middle of the pandemic, all the activities coming to a standstill and the prices will crash. And when that did not happen, and when people had a stock out situation and started buying, the prices were stable and started increasing gradually. And then when people saw that, they started buying on a speculative mode, and that led to further price increase. And then people got more excited, started buying. So the price increase is just happening since the end of last year to now, and we don't know where it's going to stop.
We see the largest companies being favored by banks, obviously. Normally are those with the larger asset base, the more products available, larger coverage, more history. We see a constraint probably more towards the middle market across all regions. We see banks also still operating under severe operational constraints. So it's just natural to wait and expect that companies that haven't been onboarded are looking for different alternatives of financing to take longer times to be fully onboarded by a bank and to have those loans secured and funded. Still, because of the pandemic, several of the lending that is done for companies of all sizes is on a secure basis, and those require inspections and physical visits to plants and locations to make sure that those facilities are perfect condition and okay for secure lending. And that is still a limitation that banks and all companies face. Leverage is always an interesting instrument. It can be the medication that saves you and also something that can kill you. So you got to be careful what you do with that. The market is still trading at very low returns compared to treasuries and other sovereign rates, but that not necessarily translates into a wide availability of funding for the real economy. So you can see treasuries is still paying incredibly low, historical low rates, but rates for borrowers not necessarily being at historical lows. So there is a disconnect between the two.
We've seen, as well as in the US, we've seen unprecedented supportive monetary policy in the euro area, in Europe in general, since 2015, in an attempt to boost loans to households and to businesses, and to revive the country, support economic growth in general. And I think the background is set to remain unchanged. At least that's what the ECB has made very clear recently, until at least March 2022. So interest range won't change, and this should benefit, economic activity in general, and also still demand in a way. According to the latest figures we have available, the automotive sector is still far from recovering. We've seen some quarter-on-quarter rebounds in output in automotive sector in Q3 and Q4, but in year-on-year terms, the year-on-year change is still negative, so we're still below the levels observed 1 year ago.
All our sales go into construction. I mean, broken down between traders, end users, stockists, fabricators. So primarily construction is what drives. UAE and GCC, I would say, is primarily a trading economy. Historically, they've been traders. So they know exactly what to do to boost trade at challenging times like today. So whatever it takes, whether it be huge spending on the federal budget, whether it be interest rate cuts, or whether it be government spendings or other stimulus package. So they know exactly what to do, and they hit the nail on its head, and they get it right. So that is what is driving the demand and the prices in today's situation.
We have a country that is still politically divided. So unfortunately, now one side to be right, the other must be wrong. So any sign of moderation, we haven't seen that yet. We see historical high federal spending, and that, as Alessandro mentioned, does create the additional spending capacity to every household in the country. So even with the pandemic, we have an incredibly hot economy. Some would argue possibly even too hot in some stances. In terms of a political administration, I think President Biden is still finding his way internationally.
I do not believe that the U.S., the Biden administration will overturn its trade stance towards major trade partners all over the world, primarily with Europe. I think, well, relations will improve because obviously let's say, once Biden has come in office, I mean, the relations has already started to improve with Europe. But as far as trade is concerned, I don't expect major changes. As you know, Europe has been hit by Section 232 implementation, which has caused a lot of trade diversion from China and so on. But I do not expect major changes in the relatively short term.
You know, fabricators or re-rollers and galvanizers, the intermediaries in the value chain, always have this difficulty to play between the suppliers who want higher price and the end customers who want lower price. And managing that margin is always a challenge. It's not just a challenge in today's situation. It's historically always been a challenge. And there have been good days, there have been bad days. So the way we do it is, you know, it averages out over the year, right? When the prices go up, you know, we benefit from whatever long position that we have, and vice versa. When the prices go down, we take a hit. We try to stay away from the speculation, the speculative aspect of either the hot roll buying or the galvanized selling. We just buy what is required for that month's production, and we sell what is within our selling capacity or producing capacity.